Let's be completely honest with one another. We desire freedom and options. The freedom to work, or not work at all. The option to travel across the globe or stay close to home. The freedom to not think twice about adding guac to your Chipotle burrito. The option to sleep in past socially acceptable times. Freedom and options. That sounds amazing, but that can never be me. I will forever be in the hamster wheel, working too many hours and never spending as much time with my family as I want to. Freedom and options. I wish I could have that, but I'm just the average Joe. The great news is that every single average Joe out there, people like you and me, can absolutely achieve freedom and options in our lives. The best way to do this, the easiest way to do it, is through investing. And if you want to achieve this before the traditional retirement age, then you have to do it with dividend stocks. If you already know this information, go to this timestamp right up here. There are thousands of different companies out there that you can invest in. And the goal when we invest in a company is for them to make a profit. When a company does make a profit, they have two major options with that money. They can reinvest it back into the company to continue to grow the company, which increases the share price. Or if the company has already grown quite a bit and they're very stable and they don't have a real good use for that money, they can take a good portion of it and pay it to their investors. This is what's known as a dividend. Companies that are still growing and new will oftentimes not pay a dividend at all and instead reinvest all of those profits back into the business. Whereas companies that are much larger and already have significant exposure for their products will generally not have as many opportunities to grow, and instead of reinvesting that money or just holding it as cash, they will instead pay a large portion of that money to the investors of the company. Dividend stocks are stable and consistent companies. And when I say stable and consistent, what I'm really trying to communicate is they're boring companies. Companies like Coca-Cola, Procter & Gamble, Lowe's, Genuine Parts. Companies that create auto parts for millions of customers, that help the average Joe complete home improvement projects. Companies that offer many household products and have significant market share in many consumer products. They consistently make money in good times and bad. Through the dot-com bubble, through the housing crisis, through COVID-19, these companies keep making money and they raise their dividend. I love investing in dividend stocks because I never have to worry about them going to zero and failing as a company. There are some great companies out there growing like crazy. But the truth is, with many growth companies, they are just one great competitor away from being just average or being potentially out of business. Albert Einstein, who was a pretty smart dude, once said, "Compound interest is the eighth wonder of the world." Compound interest is the most powerful force in the universe. Dividend stocks will often pay dividends on a consistent basis, whether it be monthly, quarterly, or sometimes annually. When you are paid a dividend, you can do whatever you want with it. But the best thing you can do is to reinvest that dividend into more shares of the company that you already own. When you reinvest the dividend, you own more shares. And when you earn more shares, you increase your ownership in the company, which means higher dividend payments in the future. This is the direct manifestation of compounding interest. And this can be an automatic process that requires no decisions or actions on your part. Sometimes this can be a slow process, especially in the beginning, because in the beginning, you don't see the magic happening. It's very subtle. Let me show you. Let's talk a little bit about the Coca-Cola company. This is a dividend stock that is the gold standard for dividend stocks. It's been paying dividends now and increasing that dividend every single year since 1959. I was able to collect data, both price and dividends, for Coca-Cola all the way back to 1962. Now I know this is a long time, but let's say you had $1,000 sitting doing nothing in 1962 and you said to yourself, I'd like to just put this money away and forget about it until 2022. I won't add any more money. I'm just going to reinvest all of my dividends. What would actually happen during that time? As you can see here, the portfolio balance was worth very little all the way through around 1990. But then things start to change quite a bit. This is portfolio balance. The red line is reinvested dividends. The blue line is not reinvesting dividends at all. And the yellow line is a combination of the portfolio balance and all dividends that were paid to you as an investor, even though you didn't reinvest them. Look at the difference in value here. If you had reinvested all dividends, your portfolio would be worth $1.169 million. You didn't add any more money. you just reinvested all of your dividends. However, if you had not reinvested dividends, your portfolio would only be worth $227,966.58. If you included the dividends that were paid to you, because I think that's a reasonable and fair way to compare apples to apples, then your portfolio would be worth $316,000. So $316,000 compared to $1.18 million. This is the direct power of compound interest and reinvesting dividends of your dividend stocks. This is the total amount of dividends paid over that same time frame. The numbers are very similar all the way through around 1994, 1996. After these 60 years, which I know is a very long time, total dividends paid without reinvesting dividends would only be $91,000. But if you reinvest all dividends, you would have received in that same time frame $355,000 in dividend income. This is really a great example about these small decisions to reinvest dividends over time will lead to passive income that leads to freedom and options. Remember, with dividend stocks, the company is regularly paying you dividends. In other words, they're paying you income. With a stock that doesn't pay dividends, in order for you to actually realize income and actually live off of the asset, you have to sell shares. But with a dividend stock, you don't have to do that. This becomes even more important when we think about how the market is always fluctuating. Sometimes the market is high, sometimes the market is in a correction and it is much lower. As an investor, you don't want to sell shares when prices are low, you want to sell them when they're high. But with dividend stocks, you don't have to worry about timing the market at all. You have cash flow in good times and bad times. When markets are up, and when markets are down. Yes, Apple and Microsoft and Netflix are great growth stocks. And yes, Apple and Microsoft also pay a small dividend. But at the end of the day, these companies are just one great competitor away from not having a competitive advantage. So when it comes to me and being able to create freedom and options in my life, I choose dividend stocks. If you liked this video, make sure to check out this one right over here. Now that we've proved the overwhelming case for dividend stocks, the very next video is going to help you apply this information and build your very first dividend stock portfolio, starting with just $100. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.